In this lecture, we will go over the CFA Level 1 reading on monetary and fiscal policy. First, a few introductory remarks. Government decisions and actions can have a large impact on the economy. This is because governments are generally the largest employers and the largest borrowers in most economies. Broadly speaking, there are two types of government policy: monetary policy and fiscal policy. Monetary policy has to do with interest rates and money supply. Fiscal policy has to do with the spending and taxation decisions made by the government. The overall goal of these policies is generally stable economic growth and low inflation. The way this reading is organized, Section 2 describes monetary policy in a fair amount of detail, Section 3 covers fiscal policy, and then Section 4 is a short section which talks about the relationship between monetary and fiscal policy. Section 2, Monetary Policy. Monetary policy attempts to have an impact on the economy by influencing the quantity of money and interest rates. As I mentioned, this is a long section. It has several subsections which are shown here. We will talk about the concept of money, the role of central banks, the objectives of monetary policy. We will then understand what we mean by contractionary and expansionary monetary policies and the neutral rate. This is a neutral interest rate. And finally, we will talk about the limitations of monetary policy. At this stage, I want you to do example 1, which illustrates the difference between monetary policy and fiscal policy. Section 2.1 deals with money. In order to understand the importance of money, let's think about a world without money. Such a world would have to rely on barter trade. And for barter trade to work, there would have to be a double coincidence of wants. This means that if farmer A, who produces cotton, wants milk, what he'll have to do is find some person who is willing to accept cotton in exchange for milk. And as you can imagine, this would be extremely inefficient. If we have money in an economy, then barter trades would not be necessary. Traditionally, money has been defined as a medium of exchange. And for money to be a medium of exchange, it must have the following qualities. It must be readily acceptable. It must have a known value. It must be easily divisible. This means that we should be able to buy goods and services with a low value, and we should also be able to buy expensive goods and services using money. Money should have a high value relative to its weight. This is simply a practical consideration, and obviously money should be difficult to counterfeit. You need to understand that money fulfills three important functions in a modern economy. As discussed, it acts as a medium of exchange. Money also provides individuals with a way of storing wealth. We save a certain amount of money now, and then this money can be used in the future. And finally, money provides society with a convenient measure of value and unit of account. The key point here is measure of value. When we go and buy a new car, and if the salesperson tells us that this car is for $20,000, then we know exactly what this number means. We've talked about the functions of money. Now let's consider the money creation process, and we'll go over an example which is presented in the curriculum. Let's say that in a given economy, the bankers come up with a reserve requirement of 10%. What this means is that when people deposit funds in a bank, then the bank is required to keep 10% as reserves and the rest can be loaned out. So what happens if a customer makes a €100 deposit in the First Bank of Nations? This is shown as a liability on the balance sheet of the First Bank, and this is a liability because this money really belongs to the customer or the depositor, and the depositor can come at any point to the bank and demand this money. Given a reserve requirement of 10%, the bank must keep €10 and the rest can be loaned out. This money is loaned out to another customer. That customer will then go deposit the money in his bank, and let's say that is the Second Bank of Nations. Given the 10% requirement, the Second Bank of Nations must keep 9 as reserve and the remaining 81 can be loaned out. And this process can continue. So notice that with an initial deposit of 100, this was the initial amount of money. But because of the fractional reserve system, the actual amount of money in the economy is much more. That is because if you ask the first customer how much money he has, he will say he has 100. The second customer or the second person in this example will say that he has 90 and so on. So clearly the amount of money in the system is more than that initial amount of 100. As I mentioned, this is because of the fractional reserve system, and as you might have gathered, the fractional reserve system suggests or says that when a certain amount of money is deposited in a bank, a certain fraction, which is 10% or 1 over 10 in our example, must be kept as reserve and the rest can be loaned out. Because of this, the money created is more than 100. So how much money is created? There is a long mathematical proof for this, but all you need to recognize is that the amount of money created is equal to the new deposit, which is 100, divided by the reserve requirement, which is 10% in our example. This needs to be expressed as a decimal. So the money created is equal to 1000. Here you also need to understand this term, the money multiplier, which is simply 1 divided by the reserve requirement. 1 divided by 0.1 is equal to 10. So in our example, the money multiplier is 10. Now I want you to do example 2 from the curriculum. Also do this simple example. You are given the reserve requirement and here is the additional deposit. How much money is created? The answer is quite straightforward. It is 500 divided by 0.08, which is 6250. We have talked about the functions of money and we have talked about the money creation process. Now let's understand exactly what we mean by money. So what is money? Going back to the previous slide, is money the €100 that was initially deposited because that was the actual paper money, or is money the €1000 which essentially is a sum of all the deposits? In most economies there are multiple definitions of money. We have a concept of broad money versus narrow money. Narrow money would be typically notes and coins and the most liquid deposits. Broad money would include narrow money plus less liquid deposits. If you look at Exhibit 3 in the curriculum, this gives the definition of money for several large economies. I have picked the definition for the United States, where narrow money is generally defined as M1. This comprises notes and coins in circulation, traveler's checks, demand deposits, and other deposits on which checks can be written. Simplistically, you can think of this as coins, notes, traveler's checks, and liquid deposits. M2 is a broader measure of money. This includes M1 plus savings accounts, money market deposits, time deposits less than 100,000, plus other balances in retail, money market and mutual funds. The larger point to understand here is that M2 is a broader definition of money which includes M1 plus other deposits which are less liquid than the deposits which are covered under M1. Also note that credit card balances are not considered part of money. We now come to the quantity theory of money, and this is quite important from a testability perspective. This theory asserts that the total spending in money terms is proportional to the quantity of money. And here is the equation which you need to remember, and we've seen this in an earlier reading also. The quantity of money multiplied by velocity is equal to price level into real output. The velocity of money stands for how often money changes hands in a given period. This equation can be used to explain the concept of money neutrality, and in simple terms, here is the concept. If we increase the amount of money supply and the velocity stays constant, then the price level will go up and the output will stay the same. In other words, we cannot increase our real output simply by increasing money supply. Connecting this with the monetarist school of thought, which we discussed in an earlier reading, according to monetarists, the price level or changes in price level are influenced by changes in money supply. So if we want to target a certain increase or a certain change in price level, that can be done through changes in the money supply. Demand for money. Demand for money is the amount of wealth that the citizens of an economy choose to hold in the form of money rather than in bonds or equities. This is an important point. So either the citizens of a country hold money in the form of money or cash, or they invest in bonds and equity. What are the motives for holding money? Here are the three major motives. Transaction related. We need to have money in order to do our transactions. Roughly speaking, transaction related balances are proportional to the GDP. As our economy grows, then the transaction related balances increase. The next category is precautionary. Here we keep a certain amount of money in order to protect against emergencies of different sorts. And finally, there is a speculative balance, where if we speculate that bond markets and equity markets are not going to do well, then the amount of money or our demand for money then will be higher. On the other hand, if we expect the bond market and the equity markets to do well, then our demand for money will be low. Now I want you to do example 3 from the curriculum. The supply and demand for money. As with other markets, the price of money is determined by the interaction of demand and supply. This curve is the money demand curve, and if we have interest rates on the y-axis, quantity of money on the x-axis, then as interest rates go up, the quantity demanded goes down, and we just saw this on the previous slide. By interest rates, we are looking at the returns on other investments, so on stocks, bonds, etc. when we are getting better returns on stocks and bonds, then our demand for money will be less. That's why this is a downward sloping curve. The equilibrium interest rate is based on the intersection of supply and demand. And to understand this a little better, let's say that the interest rate is set at this high level of I1, then the supply of money will outstrip demand. If the supply of money is very high, that means that people will want to invest money, and let's say people invest in bonds. With lots of investors buying bonds, the price of bonds will go up. Price of bonds going up means that interest rates will come down. So the interest rate then will fall to this equilibrium point. And the same sort of argument can be used to show that if interest rates are set at a low point, then they will automatically adjust until we get to equilibrium. Another point has to do with the short run impact of an increase in money supply and then the long run impact. If there is an increase in money supply, then look at what happens to equilibrium rates. If money supply is shifted to the right, then interest rates come down. In the short run, that might increase aggregate demand because interest rates are lower. So in the short run, aggregate demand goes up. So in the short run, it is possible that output goes up. But as we saw in the previous reading, over time, the output will fall back down to its original level because real output is based on the real input, so the real amount of labor and resources. So eventually what will happen is the price levels will go up and the output will come back to where it was originally. And this again goes back to the theory of money neutrality, which says that by simply increasing money supply, we cannot increase the output in the long run. We now come to the Fisher effect, which relates nominal interest rates with real interest rates and expected inflation. The relationship is quite straightforward. The nominal interest rate is equal to the real interest rate plus expected inflation. The Fisher effect is directly related to money neutrality because if the money supply is increased, that will have an impact on inflation and expected inflation. So that number will go up. The nominal interest rates will go up, but the real interest rate or the real returns will stay the same. And this concept of money neutrality keeps coming up. So I think it is quite important from an exam perspective. When we add an element of uncertainty to our investments, then we can say that nominal interest rates have three components: the required real return, expected inflation, and risk premium. This connects with material that you see in quantitative methods and fixed income, but the idea is straightforward. Let's say that we invest in a corporate bond where the return is 15%. This return has three components: the required real return, and let's say that number is 4%. There is an expected inflation. Let's say that we are in an environment where inflation numbers are relatively high. So let's say that inflation is 10%. This is actually expected inflation. And then 1% would be the risk premium. If we are investing in this bond, then clearly there is some uncertainty, there is some risk, and the premium that we as investors demand for that risk is reflected by the 1%. In fixed income, we will then further subdivide this into different kinds of risk, such as credit risk and liquidity risk. But here you just need to recognize that investors demand a return for the risk that they might be taking. Now I want you to do examples 4 and 5. Example 4 is extremely important. This actually has some MCQ questions. And then example 5 you can go over if you have time. This talks about Margaret Thatcher's use of monetary policy in the UK. Section 2.2 deals with the various roles of central banks, and here is a list that you need to memorize because I can easily see a question on this material showing up on your exam. The central bank is the monopoly supplier of currency in a given economy. The central bank is the banker to the government and the banker's bank. So when banks make deposits, they make deposits at the central bank in their country. The lender of last resort, if a particular bank is in trouble, then it will go to the central bank for help. And if you have time, you can take a look at example 6, which talks about the Northern Rock bank run and how it was bailed out by the central bank. Central banks are the regulators and supervisors of the payment systems in a country. Every year millions of transactions or millions of payments happen, and the authority that oversees that system is the central bank. Central banks conduct the monetary policy of a given country or economy, and central banks supervise the banking system. Here it is important to note that it is possible to have multiple supervisors or multiple regulators. So while the central bank will always be one of the regulators, it is not necessarily the only one. Objectives of monetary policy. The primary objective of monetary policy in most countries is to maintain price stability, or in other words, to keep inflation in check. In this subsection, we will go over these concepts. Since the main objective is controlling inflation, we need to understand why inflation is so bad. What are the costs of inflation? Then what are the monetary policy tools available to central banks to control inflation? We'll talk about the concept of targeting inflation and exchange rate targeting. But first I want you to do example 7 from the curriculum. Costs of inflation. Broadly speaking, we can either have expected inflation or unanticipated inflation. Unanticipated inflation is also called unexpected inflation. This is the more dangerous category, but first let's understand the cost of expected inflation. The two costs related to expected inflation are menu costs and shoe leather costs. Simplistically speaking, menu costs means that firms need to keep updating their menus to reflect new and higher prices. There is a cost associated with that, and that's called menu costs. Shoe leather costs means that people need to constantly go to the bank, get more money, and in the process their shoes get worn out, and metaphorically that essentially is another kind of cost. So these are the costs associated with expected inflation. As you can see, these are not substantial. In addition to these costs, we also have unanticipated costs which can create more problems. In addition to these costs, we also have these costs which are associated with unexpected inflation, and these are much more substantial. Unexpected inflation can lead to inequitable transfer of wealth between borrowers and lenders. And to understand this, think of a situation where a government borrows from its people or the citizens. If the government borrows at a fixed rate and the expected inflation when this borrowing happened was 8%, and the rate of return was based on this expected inflation. But during the life of this bond or this borrowing, inflation goes up substantially. Let's say inflation increases to 15%. Then the amount that the government will return or repay in nominal terms is still the same. So if the government borrowed 100 million, the government will simply repay 100 million. But because of this higher than expected inflation, in real terms, investors will lose out. So in a sense, there is an inequitable transfer of wealth between the borrowers and the lenders. In this particular example, the borrower ended up doing well at the expense of the lender. If we have unexpected inflation, then this will give rise to risk premia in borrowing rates and the prices of other assets. The point is that if we as investors are unsure about expected inflation, then we will demand a premium when we invest, and that premium will be the premium associated with unexpected inflation rates. Because of that premium, rates will be higher, and from a company perspective, the cost of funds or the cost of raising money becomes higher, which obviously will have a negative impact on the economy. And finally, unanticipated inflation reduces the information content of market prices. We'll now talk about the three monetary policy tools. The first one is open market operations. This is where the central bank either sells government securities to commercial banks or buys government securities from commercial banks. When securities are sold to commercial banks, then money is being taken out of the banking system and the money supply or the money in circulation comes down. When government securities are bought, then money is being injected into the banking system and the money supply increases. The second tool is the central bank's policy rate. This is typically the rate at which central banks are willing to lend to commercial banks. In many countries, this is called the official interest rate. It is also called the discount rate. Generally, the policy rate is implemented through an agreement called a repurchase agreement, where the central bank sells a security with the commitment to repurchase it after a specific number of days. And because of that commitment to repurchase, this is called a repo or a repurchase agreement. And the rate that is implicit in this agreement is called a repo rate. Obviously, repos can be used in other scenarios also, but because repos or repurchase agreements are the mechanism used by most central banks, that's why we are talking about this concept over here. Another important rate is a base rate, and again the exact name will vary from country to country, but this is the rate at which commercial banks are willing to lend to each other. The federal funds rate is a US rate, and it is referred to quite often. You need to know the definition of this rate. It is the interbank lending rate on overnight borrowing of reserves. I don't think this is overly testable because this is a very US context. The main point you need to recognize here is the following. If the policy rate goes up, then the amount of lending in the banking system or the amount of lending in general will be down, and the money in the system will be down. On the other hand, if the policy rate is decreased, then the lending will be up and the money in the system will be up. The third and final tool is the reserve requirement, and we saw this earlier with the fractional reserve system. If the reserve requirement is decreased, then the multiplier, which is 1 over the reserve requirement, increases, and this is a way of increasing money supply. So the relationship is, if the reserve requirement is up, then the amount of money that is created is down. On the other hand, if the reserve requirement is down, then the multiplier is up, which means that the amount of money created is up. Let us now take a look at the monetary policy transmission method in a little more detail. Say the official policy rate is increased. What is the impact on the market rates or base rates? Obviously, this rate will go up because now the cost of borrowing for banks, where banks, if they were to borrow from the central bank, that cost is higher. So the rate at which banks lend to each other, or the rates at which banks lend to consumers, is higher. What is the impact on asset prices? With higher interest rates, asset prices will come down, because as you see in the equity segment of this course, when rates go up, interest rates go up, that means that the rate at which we are discounting future cash flows is up, and if we are using a higher discount rate, then asset prices will be lower. So the official rate is impacting the market rates, official rate is impacting asset prices, and these rates or variables also interact with each other. We also need to be concerned about market expectations and confidence. If rates are going up, prices are coming down, then that might lead to negative expectations or bleak expectations of what is to come. Exchange rate is also important, but this is something that we'll see in more detail in a later reading. But simplistically, what we'll say right now is that typically when the interest rates go up, then the local currency strengthens, which means that exports will become less. If our goods are more expensive now for the rest of the world, then the demand will come down. So based on what we are talking about here, both the domestic demand and the external demand will come down. We are saying that all these variables impact both domestic demand and external demand. So overall, the total demand is lower when the official rate is increased. In the scenario that I'm describing, the inflationary pressure will come down, which means that inflation will come down. There is also an impact of exchange rate on import prices, but this is something we will talk about later. I also want you to understand what will happen if there is a decrease in the official rate. If there is a decrease in the official rate, then market rates come down, asset prices increase, maybe there is optimism, confidence, etc. All this will lead to an increase in demand. Going back to our aggregate demand, aggregate supply model, this would cause an increase in the overall aggregate demand, which creates inflationary pressure, and we will have more inflation or higher price levels. Now do example 8 from the curriculum. Inflation targeting is an important concept. This is something that is done by the central banks of many countries. Here is the definition. Inflation targeting is where we target a certain level of inflation and then ensure that this level is met by monitoring a range of monetary and real economic indicators. The success of inflation targeting depends on these three items. Central bank independence. In other words, the government cannot tell the central bank what to do. So this needs to be the case. Credibility of the central bank. The market needs to believe that the central bank will carry out its stated policy objectives. And finally, transparency. Transparency means that a central bank is transparent about its decision-making process. In terms of independence, we need to understand that there are different degrees of independence. Some central banks might be operationally independent, others might be both operationally and target independent. If we say that a central bank is only operationally independent, this means that the government defines inflation and tells the central bank what that appropriate level of inflation should be, and then the central bank is responsible for operationally ensuring that the target is met. If we say that a central bank also has target independence, this means that the central bank also defines the target level of inflation and obviously then has the operational independence to meet that target. In addition to these 3 points, there are 2 additional features of an inflation targeting framework that are important. First, a decision-making framework that considers a wide range of economic and financial market indicators, and second, a clear, symmetric and forward-looking medium-term inflation target sufficiently above zero to avoid the risk of deflation. If you look at Exhibit 9 in the curriculum, here we are given the targets for several developed countries. And you will notice that these targets are generally in the 2% to 3% range. These targets are sufficiently above zero, and the reason is if we set a target of say 0.5%, then there is a chance that we miss this target and we get to an inflation rate of 0%, or we might also run the risk of deflation, which would be a negative inflation number, and this would be extremely detrimental to the economy. That's why central banks pick an inflation target that is significantly higher than zero, so the probability of falling below 0% is very low. Obviously, the inflation target is also not very high, because if it is too much higher than say 3 or 4%, then that will mean that we do not have sufficient price stability. So 2% to 3% is a good range for most countries. Contractionary and expansionary monetary policies and the neutral rate. A contractionary monetary policy is where the central bank raises the official policy rate. This causes the growth rate of money and the real economy to contract. An expansionary monetary policy is where the central bank decreases the official policy rate. This causes the growth rate of money supply and the real economy to increase or grow. And note that this is in the short run. Given the money neutrality theory, in the long run, simply increasing money supply or simply changing interest rates will not cause the real economy to increase. When we talk about increasing the policy rate or decreasing the policy rate, this is with respect to a neutral rate of interest. The neutral rate of interest is that rate which neither spurs nor slows the economy. That neutral rate will vary from economy to economy. Typically, that rate is equal to the trend growth rate. This is the trend growth rate of the GDP plus the inflation target. So if in a given economy the trend growth rate is 3% and the inflation target is 2%, then the neutral rate will be 5%. If the policy rate is set above 5%, that would mean that we have a contractionary policy, and if the policy rate is set below 5%, then that would mean that we have an expansionary monetary policy. Limitations of monetary policy. The will of the monetary authority does not necessarily transmit seamlessly through the economy. This is because central banks cannot control Number one, the amount of money households and corporations put in banks on deposit. And number two, the willingness of banks to create money by expanding credit. This goes back to our money creation process, where we said that money is created through this fractional reserve system, where if 100 euro or $100 is added into the banking system, then the banks loan this money out, and these deposits and loans help expand the amount of money in the economic system. Since the central banks cannot control how much money is deposited and they cannot control how much money is loaned out, therefore they do not have direct control over how much money is created in the system. Also note that it is relatively easy for central banks to influence short-term rates, and we say that because if the policy rate goes up, then the base rate, the short-term rate in the market, or the short-term rates at which banks lend to each other or lend to consumers, those rates go up and down easily with the policy rate. But longer term rates depend on expectations of interest rates. These longer term rates are not so easy to control. In this section, the curriculum also introduces the concept of quantitative easing, and I just want to say a few words on this because some of the questions in the curriculum mention quantitative easing. This term was used a lot after the 2008 financial crisis, where the United States and the United Kingdom injected a lot of money into the financial system. So they actually printed money and put it into the system in order to avoid the risk of deflation. So you can think of quantitative easing as very aggressive monetary policy, or you can think of it like an open market operation, except that here the government is actually printing new money and putting it in the system. Now I want you to do example 12 from the curriculum. If you have time, you can also read example 11.